Hi, my name's Andre Liebenberg. I'm the Chief Executive Officer of Yellowcake PLC. Yellowcake is the uranium investment vehicle. We essentially hold only physical uranium, a little bit of cash. So we provide investors with the opportunity to invest in the uranium commodity through our shares.
Andre, good to see you. I haven't seen you since I think a couple of Adabas ago. Exciting times at the moment. Uranium price going through the roof. A lot of people leaning in to see what all the fuss is about. Kick off. Let's try and help people understand precisely what you do. You purchase uranium and you hold it. So how do you make money? How do we make money? Why will we make money?
Okay. So Yellowcake is essentially a capital play. When we listed in 2018, we raised $200 million. We spent $170 on uranium. We bought 8 million pounds at that time at $21 a pound. And we buy and hold for the long term. We have this contract with Kazatomprom where we can buy up to $100 million worth of value of uranium each year. And we can do it completely at our option. It's a 1st of January to 31 December option. We can do all of it, none of it, multiple tranches. And the pricing mechanism is essentially the spot price. So it's the average of the two quoted weekly prices from Trade Tech and UXC. And the beauty about that option is it allows us to go and purchase $100 million of uranium essentially at the spot price. And as many of you would have heard, today's spot market is extremely tight. To try and buy 100,000 pounds, 200,000 pounds is going to be difficult and will impact the price. To try and buy 1.5 million pounds or £1 million is a different deal. So that's a very attractive option for us. It runs through to 2027. So a framework agreement that was put in place at the time of our IPO, just to talk about how do people make money. So when we IPO'd, we had we raised $200 million, so $200 million market cap. At the $100 per pound uranium price, our net asset value is $2.2 billion. So we're up 10 times in asset value in the last 5 years. We IPO'd at a price of £2. Our share price today is sitting a little over 7. So, it's also been done quite well. During the course of the last 3 years, we've raised almost $600 million of uranium, of cash to essentially buy more uranium.
Okay. Great. So there's a few moving parts there we should be able to get into. So the deal with Kazatomprom at your election, as to whether you do or don't, through to 2027. 5 years ago, hindsight's a wonderful thing, isn't it? 5 years ago, $21 compared to today's prices, that's a fantastic return. Today, buying at spot, is that quite as clever? And how do you make margin? You've got to believe that the uranium's got a long way to run.
We do, certainly in the medium term. When we IPO'd, we took the view that uranium was a commodity. Commodities are cyclical. We convinced ourselves that we were closer to the bottom of the cycle. At some point, we're going to get to the top of the cycle. That's the way commodities work. But, if you look at what underpins that, and that's supply and demand. Demand has got a whole lot better over the last 5 years. I think back at 2018, the view was that the demand side would grow 1.5% per annum. I think we're now looking at 3.5% per annum. So demand has got a lot better. There's been a big tailwind from government policy, all these carbon neutral goals. There's been a big tailwind from the invasion of Ukraine and energy security, energy independence. We're now starting to see SMRs, moving forward in a meaningful way. And against that backdrop, supply hasn't really moved. The peak of supply was 2016, 160 million pounds. I think this year, we're going to get to 140, 145 million pounds. So, to me, this is very much a supply side story. And in this industry, you don't flick a switch and expect supply to come on instantaneously. It takes time. If you look at the big new greenfields projects, they're going to take time to come on stream. So I think, the kind of disconnect we've seen, with the spot price moving through 100 and above most people's views on incentive pricing, it's trading really on the shorter to medium term dynamics around supply. You're not going to see meaningful supply come on in this industry before the end of the decade.
Right. So it's moved from buyer's market to seller's market. We can see that being reflected in the price. So we'll stick with the Kazatomprom thing. I guess probably the question asked of you most frequently at the moment, and I guess most frequent conversation in chat rooms and so forth, is going to be around Kazatomprom's ability to supply into contracts for you. So can you just give us an update as to, where that relation's at, what, and obviously we'll talk about your NAV positioning in a moment, but just Kazatomprom relationship with you and the ability to supply into existing contracts with you.
Yeah, I mean, it's a very good question, Matt, and one that is quite topical ever since our last equity raise in October of last year, which, by the way, was at 65.50, and that's not that long ago. Am I concerned that Kazatomprom won't deliver the £1.5 million in Q2 this year? Absolutely not. And there are a few reasons for it. Firstly, when we do the deal, when we raise the equity, we've agreed the price beforehand. Once we raise the equity, we know how much money we've got. We then agree the volume, which is simply, the amount of money raised divided by the price. So we agreed the £1.5 million back in October last year, and we also agree a delivery schedule. So it's not a case that Kazatomprom have to deliver that material the next day, i.e. if they don't have an inventory, it's a problem. We agree a delivery schedule, and those schedules have been moving out, which I guess speaks to the fact that production's not that easy. So we agree a delivery date, and then they can plan it into their production schedule. Also, it's not like the Cameco Inkai joint venture. We don't receive material from a specific mine within the Kazatomprom portfolio. We can get it across their whole portfolio. So again, they have flexibility. And the third piece on that is that worst case, if they don't have the material, they could do a location swap. I don't have to get Kazakh material. If there's an issue, maybe they talk to their Chinese customers and say, can we do a swap with you? We'll give you a product in China. Can you swap some stuff out of Namibia into Canada? Or do you have some stuff in Canada for us? So, they've got a lot of flexibility, A, on timing, B, across their whole portfolio, and B, worst case, that, they can do location swaps. And then the most important factor, I think, is Kazakhstan and Kazatomprom are really pushing and pride themselves as being a reliable supplier to the West. We're, I think, their only customer that puts out announcements when we get deliveries. When they deliver to the utilities in the US, you don't see an announcement every time they do a delivery, but we do make announcements. So, and in the past, Kazatomprom have been very pleased that we've made these announcements because, with the whole Trans-Caspian route and all the other issues, if we say we received the material on schedule, it's another tick in the box for Kazatomprom as a reliable supplier. So if they did miss the delivery, and we put out the announcement, Kazatomprom missed the delivery, firstly, I don't know what the spot price would be. And secondly, I think it would damage that reputation. So for those reasons, I think Kazatomprom not delivering to us is an extremely, extremely low likelihood.
I mean, I guess in a very meaningful way, it's a paper trade, right? You hold the value of that uranium at an agreed price, whether you've taken delivery of it and stuck it in Cameco, Canada, or Urano with the French. Does it matter to you, or is part of the remit of your company to actually have physical uranium, and that's the only point at which you can take the book value of it? I mean, how does it work on the financial side?
So we are physically backed, but again, the question is, so when in October we agree the volume and the price, and we agree a delivery, we don't pay for it then. So we actually sit on the cash. Once we receive the material, which will be Q2 this year, we've got 10 days to pay. So we don't run any credit risk, but we run price risk because we agreed that purchase at 65.50. If they don't deliver, then we have to go and purchase uranium, and it's not 65.50. So, maybe we're just going to do one massive share buyback. But so we run price risk, but not credit risk.
Right. So there's a kind of period, there's a kind of grace period. So when you say the Kazatomprom, it's kind of moving up in terms of the delivery dates because of everything that they've announced in the market, and everything that probably a legacy of everything that happened during COVID. Things have got tougher to deliver. So you're saying that you've got to physically receive that within a reasonable time frame. You can't hold that price at the point you place the order unless.
No, the price is held. Yeah, the price
is held. Okay. Just want to be clear.
Yeah, the price is held all the way through up and when we get the material, then it's ours. But yes, the price is fixed. So that's why I say we run. If we had to replace that volume, we run price risk on it, but no credit risk.
Right. And is this kind of like a one deal company, i.e., you only can acquire from Kazatomprom, or have you got other inflows?
No, so it's not exclusive in the sense that we can go outside of the Kazatomprom contract. So if you look in 2021, we did 3 equity raises. We bought 9 million pounds of uranium. 6 came from Kazatomprom and 3 came from the spot market. So we have done spot market purchases.
Right. But that's obviously very, very difficult at the moment.
It's much, much harder now. So, that's why I think that contract's valuable.
Right. So should we talk about this NAV element? Because people need to understand that it's like we've spoken to a North American company here in the same position regularly. So explain it to people new to this, and then we'll kind of get into how you manage that.
Yeah. So the NAV, because we're at a discount at the moment and have been for some time, it's frustrating. But think about it a lot. The folk that trade that uranium spot price are not the same folk that trade my share price. There's a disconnect as to the actors in the uranium spot market and the equity market. So the equity market, our share price is much more impacted by macro events. So if you go back last January, we were at a premium to NAV. We did an exercise of the previous year's option. And, within a short space of time, we had Silicon Valley Bank, we had China's COVID part 2, we had crypto, and that had a big impact on the equity markets. We're a liquid stock. We've got quite a big retail following. So in some sense, we get treated as an ATM. If, we've generally been up. So if people need liquidity and they can sell a profitable stock that's liquid. So there are factors that impact our share price that are more macro related than the specific commodity. So if you look at last year, the commodity went up the whole year, and yet, for a large part of the year, we were at a discount, and as was a peer company. So I think that's the first thing. And secondly, if you look at what's happened over the last few months, I think in the last 2 months, the uranium price has gone from 80 to 100, 106, and tracked back to 100. When the price moves up that rapidly on not a lot of volume, the share price in some sense plays catch up. So in that rapidly rising uranium spot price, you won't see the share prices front run it. So I think that's been another factor. When it runs up that hard, some investors say, well, there's going to be a bit of a pause. It may trace back a little bit, or we'll go sideways. So the equities lag a little bit. So I think, those are the sorts of factors. In the past, we've done share buybacks. I guess you could think of it as a redemption mechanism, because we buy back our own stock and therefore buy back uranium, at a discount to the spot price. And we've done, I think it was a $10 million buyback, a $3 million and a $2 million. That was against a much, much smaller company. Today we've got about $30 million of cash. If we did a buyback using all of that cash, we'd go through it in 5 days. Our liquidity is such, we're trading over 1 million shares a day. We would go through that in 5 days. And on a $2 billion asset value, I don't think it will really, it won't move the needle. So we need to think about that discount differently. And we've got a strategy session with our board coming up in a few months' time. We will explore all the options. Why does it exist? Is there anything we can do about it? We're currently AIM listed. Could we go up to the main board? We're of sufficient scale. So the other things we need to think about beyond just the straightforward buyback, which has kind of worked for us in the past.
Yeah, I did. That feels like it would. There's a rude phrase for that, but so we won't go there. It just feels like it would be not as effective as some of the other things to which we'll be fighting against it. Like say, like broadly, the markets for equities at the moment. The last 3 years have been a tough one for juniors, and I think you just about to say you kind of crept out of the junior space now. But things which I guess for me, I'm looking to see, well, is this still investable? Is this still an investable story? Because there's moments where, because of the discounts now, you're slightly out of control, and you're describing an environment where macro events affect your ability to be in control. So I've got to believe that the supply side of your story is a strong one and believable. And you're talking to the converted here, but for again, people looking in from outside, can you point to any sort of specific things you think are up and coming above this sort of general, reactor build out across the world and the change in political narrative around it, and zero carbon targets where it be 20, 30, 40, or 50, depending on which countries you're talking about. So what else gives me certainty around this as an investment thesis, investment class, and a company, a way to invest in uranium?
Yeah, so I would argue that the demand side is very distributed. So, we've got 430 reactors in 31, 32 countries generating 10% of the world's electricity. Against the supply side, we're essentially 4 companies. I think 5 mines produce half the world's uranium, and 4 companies, 75% of 4 jurisdictions, 75% of the world's uranium. So you've got an extremely concentrated supply side against a very, distributed demand side. So, if there's a impact on one element in the demand side, it just doesn't have the same magnitude as the impact would be on supply. And, the case in point would be Kazatomprom. They're due to come to the market on, I think, tomorrow or the next day with their results. And they spoke about increasing production, going back to their, subsurface levels. Then they came out and said, no, that's going to be a challenge. And I think that it needs to remind everyone producing is really, really hard. Everyone thinks it's easy. You need people, you need supply chains, all of those sorts of things. So I think, we can get excited about all, the carbon neutral goals and SMRs, but who's going to produce that stuff? We've got Kazatomprom coming out with their announcement, Cameco a week later, and we know those are the 2 big guys. They are the big producers. They account for, a huge chunk of global supply, and they're struggling. So if they are struggling, and you're a junior company, surely you're not immune from the same issues that they face. And they, they've been producing for decades. They know how to do this stuff. It's just really, really hard. So for me, I think that certainly in the next 3 to 5 year time frame, God forbid we have an event at a mine. You have weather events; they happen. You have strike events. So that the supply side is so tight here that any hiccups on the supply side and the price could almost go to anything. I say that jokingly, but it's that finely balanced, and it's going to take till the end of the decade to fix the supply side in a meaningful way.
So are you saying that there's a gap between supply catching up with current demand, let alone future demand, which potentially, because the size of the market, I think that people don't realize this, uranium is a very tiny and small part of mining, which in itself is a very, very small sector indeed. So any change in the ability to produce, and we saw that with COVID coming along and the Cameco shutdowns and Kazatomprom shutdowns, it just basically the market was dead. There was no production. It was extremely small levels of production. If that happens again, it's going to have a dramatic effect on the market. So are you saying that we've got a gap now where the lack of current forecast supply, let alone allowing for any issues that some new producers or wannabe producers will have, investors could do quite well for themselves? How do you frame that?
Yeah, exactly. And if we go back a few years, we had, there were a lot more inventories around. The spot market was much more liquid and supplied. So, you've got that release valve has also gone. Then we looked at the coup in Niger and the impact on that. Cameco, the MacArthur ramp up is being tricky. It's just that's why I think in the sense that there is. I don't think the price. Will it go back below 100? I don't think so, but certainly not back below 90. Could it go to 150? Absolutely. I think we're in that tight window now on the supply side. And as I said, supply will come if we fast forward 10 years. The new mines will come on stream, and then people will eke out, extra bit of capacity from tweaking, the facilities. But right now we're kind of at the opposite end, where everything's stretched on the supply side, and any hiccups will have an impact on the price.
Okay, it's interesting indeed. I'm trying to think of any sort of other kind of red flags that I need to be aware of, which increases or the chance of success, because it is a kind of one of our biggest questions. It's also been bound to me personally, also been bound to everyone on the team here, which is have I missed the boat? Is this thing peaked? I think you're arguing a good case that there's a lot of drivers who suggest that there's going to be a kind of big gap that needs filling in the next sort of 3 to 5 years. Is there anything that we're missing or perhaps need to be aware of?
No, I think obviously we've had these announcements, the restart guys, and we'll see how that goes. And I think we've seen 1 or 2 minor slippages already. And as we see more information and the ramp ups come, we'll see. It'll again, I think, provide evidence of how hard it is to produce. So there's just not. I just don't see anyone coming up with by the way, we produced an extra 10 million pounds. It's just I just don't see any visibility on that side. I think there's much more risk of we're 1 million pounds under or something like that. I think there's much more risk of surprises to the downside than surprises to the upside.
Right, and coming back to you briefly, Yellow Cake. You've got to have a view on the market. If you're saying that you can be affected by global events as you are, and one of those has been the prolonged downward pressure on equities for the last 3 years, partly presumably because of the printing of money for fun by governments around the world. But when you look at to the next 12 months, 24 months, do you see any relief in that? Because that could positively affect your ability to, in terms of the NAV component, to be able to actually get out there and precious pounds in the market as well. So given that uranium's the only kind of green shoots in the market at the moment, the rest of it seems to be waiting for some kind of response from whether it be the Fed or whether it be some global event. How do you read it, and and do you think that could actually release the valves for you as well on another level?
Yeah. So the macro puts pressure on our NAV, but if we do get back to par or a premium, we've certainly seen, even in a tough macro environment, there is money for the right asset class. So I think uranium has shown. Last year we did two equity offerings, and both were oversubscribed. So I think for the right asset class, there is money. I've been trying to read a lot of banking stuff and what's going to happen in the macro this year. We've had quite a good run in the equity markets the last couple of months. Now there's been a bit of a pause. What's happening in China? Is there going to we've got I don't know how many elections coming up this year. I think half the world's population get to vote this year, and we've got some fairly significant elections. So, I think volatility is going to be the name of the game. Are we coming out? Are things going to get better? I think so, but it's it's not going to be in a straight line. So I think there are going to be a few bumps along the road. But again, if we get into that point where we're at par, then I think we can get the equity. And just it's sort of interesting the way that the Kazatomprom option works. If I go back to October last year, So when we got the price in I think we got it on the Tuesday, price of 65.50, which was the average of the two spot prices. So we had the price pegged. We were at a few percent discount to NAV. But what happened in the next 4 or 5 days, the price went from 65.50 to 72. So at $72, we were suddenly at a premium or at par. So, on a look-through basis, we were able to raise that equity because the uranium price had moved quite significantly in a short space of time. So there are opportunities for us to come to market. But equally, we got 22 million pounds of uranium on a pro forma basis, $2 billion asset value. Growth in of itself is not an imperative. When we were a $200 million company, we were keen to get to $500 million. We needed to get our liquidity up. We became investable to a whole bunch of new folk. But given our size now, there's no imperative to grow big for growth's sake. If we can grow accretively, we will. If we can't, we still think there's a lot of upside in the uranium price.
It's kind of interesting. I was speaking to your US peer about a week or so ago, and I think he was sort of commenting on the fact that there aren't going to be any new entrants to this market who do what you do and what they do, because it's hard. It's really hard to set up. There's a real big barriers to entry in that sense. So, well, one, do you see that before I get on to my next question?
Absolutely. I think there was a lot of talk about these vehicles coming to market maybe a year, 18 months ago. I almost think they've missed the boat. I think our North American peers absolutely right. They purchased UPC. It was preloaded with 16 million pounds. When we came to market, we preloaded with 8 million pounds of surplus Kazakh material. How do you preload a vehicle today if you can only buy 100,000, 200,000 pounds? And how can that be meaningful for investors in terms of liquidity and all the other issues? I think unless you can preload the vehicle with a couple of million pounds, then it becomes a $200 million vehicle, and then it becomes, investable. But I think outside of that, the new entrants have almost missed the boat in terms of getting into this market.
Right. And just answer questions. So it's a technical question around how the buying works, because again, I'm dealing with some questions that people send in. I don't always have the answers. I certainly don't to this one, which is you say, well, if you've got cash available to you, surely in some way you can sort of manipulate the price in the sense that you can bid whatever. I guess the market, we saw what happened when it went to 106. It was a week or so ago. The whole market went into a frothy frenzy. Why do vehicles like yours and like your peer not do that? Why does that not make sense?
Well, but I think you fire one bullet, it's not sustainable. So unless you can keep doing it, so yes, we can buy 100,000 pounds, we move the price up, and then if there's no further bids, then the price comes back down. I think the comforting factor is that if you look at the last 2 months, we haven't been in the market at all. Our North American peer has bought a little bit, and yet the price has run up $20 odd. So the price has run up not because the financial buyers are sort of cornering the market. It's the opposite. It's gone up on fundamentals. So whether it's producer buying or utility buying, it's not because one entity has hoovered up 10 million pounds. So I think it's much more sustainable. Yes, it's stripped it back a bit, and I think part of that is there were expectations that the Senate would pass the legislation earlier this year, and that sort of deferred, and maybe there's been a bit of froth that's come out the market, but it was still at $100 a pound.
Yeah, let's not forget that bit. Life is good, but obviously, I think people want to see or expect to see that kind of move through the phases, and it will be stops and starts. But I think the general trend is up, and amongst all of that, energy security is such a big component of it. I personally am looking forward to sort of seeing people coming out with firmer numbers around the SMR and what that's going to do to demand. So I think that could be super exciting. Well, Andre, all good. I appreciate you making the time to come and speak to us. I know you're busy. You're going to be down in Cape Town talking to a few people down there. I'll hopefully see it at one of the events down there. But appreciate your time. Stay in touch, okay?
Thanks, Matthew. It's always a pleasure to chat to you.